Welcome, everybody, to the Reveille Wealth Management Post-Election 2024 Market Update. I'm Stephen Weitzel, joined by my partner, Chad Smith. And today we just want to have a brief discussion about what we saw transpire during this 2024 election cycle. It's really been an unprecedented period in American politics. And we note that this is the first time since the late 1800s that we've seen the control of the White House switched parties in 3 consecutive elections, and the first time that we've had a president win non-consecutive terms since Grover Cleveland in 1892. So a really unprecedented period in election history and in American history. And so, Chad, today we really just want to talk about what we've seen transpire with the elections, what the potential impacts can be as it relates to the markets and to the economy. So take us through a handful of these things. Obviously, I know we're all breathing some sigh of relief that this cycle's come to a close, and if for no other reason, the fact that the political ads are now over. We
Thank
spent
goodness.
$16 billion on campaign ads for this election, and I think that we could all agree that that money could have been spent on much more worthy causes. But
Yeah,
with
really.
that said, last Tuesday night was a resounding victory for the Republican Party. And while there were a number of pundits that were believing that Trump would prove victorious, what really did come as a surprise to the markets is that the Republicans appear to be taking control of the House of Representatives, which, in addition to the seats that they've gained in the Senate, would give them full executive and legislative branch control. So let's just kind of walk through, some of the impacts of that, with the Republicans having this full sweep, what that could mean for the market, and then what events we see coming down the road here.
Sure, yeah. Well, what's interesting, as you just said what you said, right? The potential for the Republican complete control. For some, that's cause for celebration. For others in our country, that scares the heck out of people, right? And what we're here to say is, everybody calm down. Let's kind of be the voice of reason and look at this from more of an objective perspective.
Yep.
I think, to your point earlier, just a second ago about, kind of breathing a sigh of relief here. That was one very pronounced thing about this election, and it's kind of been true in previous ones as well. It's just the build up to the election, the uncertainty, just kind of the anxiety that was prevalent, is now behind us, right? So I think we saw that a little bit on the day of the election. The markets were moving up, and then of course, the day after the election, the very large increase in the equity markets. But a lot of that was just simply a removing of that that unknown, right? And so the markets really like predictability, and so maybe we can kind of get on with actual objective analysis of everything. So to your question, right off the bat here, one of the things that people are talking about the most is the potential for the 3 areas that Trump can have direct control without even waiting on Congress, and the 3 areas that he has more authority to act by way of executive order. Those being tariffs, regulatory decisions, and then immigration policy. So, the big one, I think, of course, has been the rhetoric around tariffs, and a lot of the threats that Trump has made. Ultimately, we think there will be some some follow through in that. I think he wasn't just talking loosely, but ultimately there really is a question about how much of those discussed tariffs will be implemented, and really the effect that they'll ultimately have. And so, I think that we need to be careful, or we need to evaluate some of the policies that are being made and the decisions early on as he gets into the office. Obviously the direct one's going to be with respect to China, also Mexico, and to a lesser extent Europe. But really, we saw, for example, even under Biden, when Biden increased tariffs on imports from China this past spring, there really wasn't as much of an impact. A lot of the effect wasn't there that people thought about. Chinese prices on Chinese goods actually still kept deflating. So some of this may be just, in terms of the effect that it will cause on inflation or pushing inflation up. We're still yet to really know the effects of that. With regard to immigration, obviously the biggest effect that we think that may have is, to the extent that there is a reduction in immigration, we could see an increase in labor costs. That could be an effect on businesses that have to deal with that, with a shrinking labor pool, if that does come down the pipeline. And then lastly, regulation. And this is where I think we could see more significant impact. And that could be in the form of reduced regulation in a lot of key sectors in the market: financials, healthcare, and energy. The energy policy, that would look like a potential boost in energy production. And then on the financial front, potentially greater M&A activity, et cetera. So, already we've seen this, Stephen. The financial sector rose considerably the day after the election. And so many of these sectors could benefit, and the economy more broadly, from reduced regulation.
So just one thing I want to make a comment on before we move on to a couple of these other things that would require Congress to be involved. But on the topic of tariffs, that since the Trump administration introduced tariffs on China and some other economies in his first term, it's ironic that as much as the idea of tariffs get demonized, and that it's going to translate into higher rates of inflation and a higher cost of goods for consumers in this country, if you go back and look at the data, and the St. Louis Federal Reserve has all of this data, that the consumer price index, the producer price index, all throughout Trump's first term, we never saw big increases. We never saw inflation run at higher levels. And then the point that you just made about how the Biden administration quietly increased a few tariffs in the spring on Chinese imports. Well, inflationary pressures have been subsiding since really they peaked out in the summer of 2022, but they've continued to come down, all in the face of having some tariffs placed, for the benefit of trying to protect U.S. business interests. So it'll be interesting to see, again, to what extent the tariffs actually get implemented, or if it's just rhetoric that's espoused as a threat and more of a hollow threat. But again, that will have certainly a market moving impact.
Sure.
Let's move on to a couple of the things that we know will require congressional involvement, and that's what would happen with tax rates, and really what's going to happen from a spending perspective, and that's going to involve this debt ceiling showdown right as we turn the calendar into 2025.
Yeah, for sure. So as many people know, under Trump previously, the 2017 tax cuts were implemented, and those were pretty considerable. And those are set to expire come the end of 2025. And so the question has been, well, to what extent those may be extended? And of course, now there's a greater potential for that with a Republican control of government in general. And then, there's also the question about corporate tax rates, et cetera. So, clearly we think there's a greater probability now for an extension to some extent of the prevailing tax rates that exist today, or likely not increased tax rates going forward. But but to your point, it still does require congressional approval and to go in that direction. And even if there is a complete Republican control, there still are quite a few Republicans that are more, kind of focused on austerity and are, wanting to be more mindful of the issues with our deficit spending and, trying to be more fiscally responsible. So it still may be a battle, so to speak, that needs to be played out.
Yeah, and I would say that I don't know if the market or to what extent the market is prepared for that. That typically there's this presumption that if you have a political party that's in charge of the White House and then of both chambers of Congress, that you're going to be able to get your agenda through without issue. And given the fiscal issues that the U.S. government is facing today, I think those are going to be a challenge for the Trump agenda in that even if Congress wants to extend some portion of the tax cuts from 2017, we're already running close to $2 trillion fiscal deficits right now. The interest on our national debt, I believe, is now our largest area of expense. It's even larger than our expense on our military each year and entitlements. And so when we have this debt ceiling, this debt ceiling come to the floor of Congress here as we turn into 2025, we may see them operate under some sort of a continuing resolution or something where they don't raise that until later next year.
Right.
And that's going to slow down any ability that the Trump administration has to get some of these types of programs passed. And so,
Sure.
I think that's a risk that the market isn't fully appreciating right now, but it is likely going to limit the extent to what the Trump agenda can actually unfold based on how that vote on the debt ceiling works out.
Yeah,
But
certainly.
let's turn our attention here, and our message to our clients and to everybody has been that instead of trying to focus on reading the tea leaves of who was going to win this election, and or waiting for the winner to be announced to decide how I want to invest, that this is why we say let's just focus on our process over prediction. And that we notice that as it relates to the stock market, at least the US stock market, as we're going to look at here, that the market has been in an uptrend throughout the entire year, really started late last year. And so, whether the market was already discounting the fact that Trump was going to win or otherwise, the prevailing trend in the market has continued post-election. We're still seeing large cap US stocks of the S&P 500 move higher. We see the same thing for mid cap US stocks. They've been moving higher throughout the year. Although, as we see here, when we're looking at mid caps, and then as we're going to turn to look at small caps, that we've seen a very pronounced advance post-election here. These uptrends have continued that have been in place throughout the year, but this is where we've seen the most sizable advance since the announcement of the election, or the final outcome of the election is really decided.
Yeah, for sure. Well, I think 2 points are important here as it relates to our approach to looking at the markets and following trend, but following, importantly, primary trends, longer term trends. Coming into the election, as we reviewed recently in our monthly update, in the month of October, there was, partly because of the anxiety over the election, there was a pullback in the markets, and there was in many areas a little bit more of a pullback, and a lot of uncertainty again, and just anxiety that was somewhat prominent. And yet what we reiterated to many folks is we see a continuation of this uptrend at this point, right? A pullback in the midst of an ongoing uptrend. And that proved to be the case post-election, of course. And then, as you just mentioned, we've seen an improvement in market breadth and a broadening out of market participation in an even more pronounced way post-election, with a lot of strength building in these mid caps, small caps, and other areas of the market below the surface. And that actually kind of leads into one of the things that you and I have talked about recently about who may potentially benefit from a Trump presidency and all these discussions around potential policies. Well, if in fact, for example, tariffs become more of a factor, and then also maybe a lower regulatory burden on companies begins to kind of develop more as well. Presumably that could benefit small or mid-sized companies a bit more. We've already seen this rotation into these areas that we felt was definitely ready to unfold. But this kind of reinforces that notion, that strength in mid and small caps since the election now.
Yeah, so I want us to look at one more market area, and then we're going to look at some of this rotation that we've been talking about. And this is in the bond market. So we've covered this on our monthly videos that, as the Federal Reserve moved to lower rates for the first time in the month of September, that for this year so far has really marked the peak in bond prices right when they elected to lower rates by 0.5 percentage point. They just the day after the election results started their next monthly or their next meeting, where they ended up lowering interest rates by another 0.25 point. But surprisingly, we've seen bond prices come down during that window of time. Kind of unprecedented to see the Federal Reserve cut interest rates in what is a somewhat aggressive style, but still see bond prices come down and interest rates go up the way that they have with the longer term maturities. But we note too that that uptrend that started in bonds late last year, it still hasn't been broken. We're still just kind of testing that uptrend line that's been in place. And so our presumption or expectation, I think, needs to be that this is still an uptrend, and we need to give this the benefit of the doubt and anticipate that it's probably going to dig in here, and we may see interest rates start to come back down, these bond prices start to go back up and resume that uptrend. And one note that I'll make there, and this kind of goes back to that debt ceiling discussion, that I think a lot of the weight that we've seen on the bond market and bond prices coming down has been related to the fact that the U.S. government is running massive deficits. They're having to sell trillions of dollars worth of bonds every year to keep this thing going. And if there's one benefit maybe to a more contentious debt ceiling negotiation, it's that if the debt ceiling is not raised as much as some would like, that it's going to limit the amount of government spending that can happen. And if there's less supply of new bonds coming to the market from the Treasury to raise that cash, then that could actually be a good thing for bond prices. So we're going to see how that works out. But let's turn our discussion, and we're going to finish here with some of these intermarket trends that we think could be both secular headwinds and some opportunities. So the first one, and we've been talking about this one for a while, is that the technology sector in U.S. stocks has been a leader for a number of years. It has carried the market to new all-time highs. But back in the summer of this year, it was running into the same highs that it did during the dot-com bubble peaking, and has started to slowly roll over and fade from there. And so our sense going forward is that we're probably likely to see this relationship continue to move lower, where technology becomes a smaller piece of the S&P through time. And that's probably a headwind, maybe for the large cap US stock names. But to the point that you were making earlier, it's an opportunity for the smaller cap stocks, where we see them retesting the lows relative to their larger or their larger cap companions that they had at the peak of the dot-com bubble, right? Where they bottomed out relative to large caps 24 years ago. They're back to that same level now, and they've really exploded higher here post-election.
Yeah, certainly. And, also this goes to the point of, as you mentioned, opportunities. You come back to the basics of the market, right? It really is just supply and demand and the amount of dollars going into certain areas of the market. And there are a couple of things to think about there. One, presumably because of the extent to which broad indices are market cap weighted these days, and so many investors just putting money in the market in the easy way, just in the S&P, for example, or indexing. What that means is investors are very underinvested in areas like small caps in general. And so, as rotation potentially unfolds, you could see a lot of dollars shifting into those areas, and that could fuel this further. And then that is sustained by the idea of the relative valuation of small caps versus large caps at this point, and historically where we are on that cycle. So that could be a thing that really attracts more capital. The other thing is, Stephen, just the amount of money that's on the sidelines now. Record amounts of money sitting in money markets, I think, or on the sidelines in cash or cash equivalents. And
Yeah, I
back
think
to
there's over $6 trillion in money market.
yeah,
And so you're right. I think there probably has been a lot of money that's just been waiting to see how this election result
Yep.
turns out before they go and commit dollars. And so maybe now with that unknown behind us, it's going to give investors more comfort, to be able to more solace to be able to put that money to work. And we've definitely seen them come into the small cap space in a large way since the election. All right, so just a quick recap of the things that we've talked about today, because we've covered a lot. While I don't think a lot of people were caught off guard by Trump winning, the one thing that the markets were really surprised about was the Republican sweep that really included the House. There was already a pretty good probability that they were going to have a narrow margin in the Senate that is larger than expected. But the fact that they can have control of the House of Representatives is something that the market was not really anticipating. And while one would presume that having the Republicans control both houses of Congress, in addition to the White House, might be good for the Trump legislative agenda, we need to remember there are a handful of things that he has control over from an executive standpoint, that he can issue executive orders for things like tariffs, regulation, and immigration. But for the tax issues and for the spending that he's going to want to do, he's going to have congressional approval to be able to do that. And what happens with the debt ceiling before he even takes office and before that next Congress even gets fully installed is going to have a big impact on his agenda going forward. But the direction of markets, the trajectory of markets that we see post-election, they were already really in place coming into this election. That's why we reiterate this process over prediction, that if you are merely focusing on identifying the primary trends of the market versus diving in too deep around who was going to win or waiting for somebody to win, this market has been moving higher for a number of months, and it's simply continued now post-election. We do think that the small cap space could really benefit here post-election. It's at a logical place to outperform some large cap stocks. It's back to a historically very low valuation, and we would expect some small cap outperformance going forward. But really one of the biggest catalysts for the market could be the fact that there's over $6 trillion that's sitting in money market that may have been waiting for the outcome of this election to get deployed, to have confidence to be able to do that. And so now that we have this bias, we may be able to see the market continue to advance both stocks and bonds.
Yep. Well, that's a great recap for us, Stephen. And so just thank you all so much for listening in. We appreciate you very much and the opportunity to serve you. If you are an existing client of Reveille and you'd like more information about what we've covered or have questions, please reach out to your advisor. Or in general, if you'd like more information about the firm and how we approach managing money for our clients using our rules-based investment discipline to navigate market environments like we've been through, please give us a call or send us an email at info@reveillewealth.com. We appreciate you joining us. Thanks so much.